$60,000 loss. Today, that investment is worth over $1.1 million. So the fact of the matter is not that you can take out your money out of the one fund at any point in time out of any of our funds. The issue is you want to make sure that you control what time it's taken out. That you take it at a time when you're maximizing your returns and not being forced into an unfavorable situation.
Yeah. And if I can just add, all of the one investment products are, first of all, they invest in liquid securities that trade every single day. So whatever day an investor says redeem, they get the net asset value that day. We don't have to go out and find a buyer. It's just, okay, Brian, you better do a trade. You know, we're not dealing with the secondary markets where you may or may not be able to find a buyer and you may or may not have a bigger or smaller discount. It's whatever it's trading at on the equity side, on the Toronto Stock Exchange, and on the fixed income side, it's whatever it's trading at in the dealer market. So we're trading in the primary markets, not the secondary markets.
Okay, my very, very last question is that on the old program, the one we're currently in, over the last 3 years, we have got a return, I won't do percentage, but dollar-wise, $5.3 million. You divide that by 3, we've averaged 1.7% return on our money in the last 3 years. I recognize the endowment's a different program, and you're saying that we could be able to, over the 10 years, go from 1.7 as high as 3.7 on an average, irrespective of inflation. So is that, you're pretty sure? You sure? You think we can do that? You know, we're trying to get the best return we can possibly get for our ratepayers, and we do not want to duplicate what happened last year. And I'm not pointing any fingers at anybody when I say that, but we do not want to repeat what happened last year. Any comments on what I just said? I'd be welcome to hear them.
If you agree to measure on a 10-year time horizon, not a 1-year time horizon.
Yeah, I understand.
Then I would say on the endowment model, you should expect a total return in the range of 6 to 8% over that full 10-year. The first 2 or 3 years as interest rates go up, maybe not. But then as they come down again, because interest rates never go in a straight line in one direction either, but I would say a reasonable expectation for the endowment model with the appropriate asset mix is a total return of 6 to 7%. If you're withdrawing just over 3%, you're leaving a cushion to provide for inflation and to buy you tolerance for volatility. I
will finish and have you conclude by getting the last word and saying that whether it's you or any other investment firm, I would hope that we invest in a company, our $70 million, I would hope if we're going to be paying out in the next 10 years over $3 million in fees, I would expect to see a return of $26 million. I'll give you the last word, and then I want to get on to the next presentation. Councillor Black?
Yeah, just, I don't know if I got this right or not. With our current policy, we can't touch the principal amount. And are you saying that with the endowment model, did I hear this correct? Maybe I didn't. That at some point we might have to dip into the capital?
Temporarily.
Okay.
It's temporarily.
It'll swing.
All right, so I did hear that right. Yeah. So we would have to change our policy to allow for that. Yeah.
Donna, Kelly, and Brian, we thank you for your presentation today. Thank you.
Thank you for all your time and for all your great questions.
Well, I'd like to do our next presentation from the CIBC Private Wealth Management. And they are going to speak about principal protected notes, which are PPNs. Gentlemen, come forward. And again, I do not have your names. If you'll give them, it'll make it easier for me.
Mr. Mayor, members of council, it's a pleasure to be here. My name's Ian Murray. I'm the local representative for CIBC Private Investment Council out of London. And this is Barry Cowell with our structured products team out of Toronto. and he's going to be taking you through some principal protected note solutions, little tutorial about what notes are, and yeah, we welcome any questions that you have.
Thank you, and again, you have 15 minutes for your presentation till we get to questioning.
Great. Am I going backwards? There you go, right there. Yeah. Perfect. And as Ian mentioned, thanks again for having us. My name is Barry Cowell. I'm an executive director at CIBC Capital Markets. Probably a fancy way of just saying I work on the trading floor. I have 15 or 11 plus years experience working in a variety of different asset classes between foreign exchange. Actually, most of my career is spent in fixed income, working with clients such as yourself. So I'm very familiar, obviously, with the Muni Act and obviously, cash requirements, protection, et cetera. And then the last 4 or 5 years, I've worked in an area called structured products, which basically just merges multiple different asset classes all in the same, product, let's say. So, structured products in general, it's been a very, very fast-growing asset class, I'd say, or for CIBC and the street in general. The slide says 2016. I can say that CIBC itself currently has, 12, 15 billion in assets under management in structured products. I would think that most of my competitors on the street would be likewise. So not a very small market segment at all. Building blocks of structured products. I really like this part or this industry or this part of the industry mainly because we can try and get very creative. We try and customize stuff like we're going to talk about today specifically for either a very high net worth individual, ETFs we work with as well, institutional accounts. We work with some of the biggest institutional managers not only in the country but around the world as well. Right, and we can get creative anywhere from working with, foreign exchange type trades, thinking about hedging with companies, let's say, they're an importer or exporter that have a natural currency mismatch, working with different asset managers in terms of creating equity structures, working with individual investors who want access to, let's say, the Chinese market that may be somewhat difficult to invest directly themselves. All the way to also what we're talking about today, principal protected notes, which is a way to access equities, let's say, in a guaranteed format. Right, so what are principal protected notes? I know there's kind of a lot up on the slide there. A PPN at its heart is a deposit note. It is not any different than a GIC, except for your first 100K is not CDIC insured. It's the guarantee is the same level of senior debt that you are allowed to invest in. But unlike traditional debt that would pay, let's say, 2% per annum guaranteed for 5 years, this typically pays a variable rate that links to something else. Right, and today we're going to talk about how we can link these to equities, right? The idea behind it is, for a lot of investors that have tough investment policies or who require principal protection, there's not much else you can do outside of just buying pure fixed income. 2% per annum, may be good for some, but this is a way to hopefully enhance the yield of the portfolio and the performance returns over time, while still giving you the same guarantee as a senior deposit note, because that's what it is. These are rated AA minus by Fitch, I believe AA by DBRS. We can get them rated by S&P as well. Okay, so this is not necessarily what you'd be facing in terms of an investment with CIBC, but it's important to understand how these are actually constructed and kind of how they work in the background. So again, in its simplest fashion, what you'd be investing in is a deposit note from CIBC. It's a promissory note that says, we promise to pay you based on the rules of whatever trade we're putting together. In the background, the way it's put together is we've got a zero coupon bond. So it's a bond that doesn't pay any interest payments. Sometimes actually it can as well. And then the other side to it is some type of equity portion, or typically we would structure these with options. Now, that said again, you are not facing the options. You own a promissory note or a piece of bond from CIBC. Right? Again, kind of constructing the PPN, just kind of the main highlight there as well. You do not face risk from the equity markets going up or down. The risk you face is the counterparty risk, which hopefully is basically 0% risk, zero risk, which is CIBC defaulting. Right, so again, just like our other senior deposit note holders, no matter what happens, no matter how we put the trade together on our end, your money is protected so long as CIBC is still in business. Okay, so I guess I want to take you through a few examples. Actually, many of these are real examples that we've customized either for some of Ian's clients or some of my others throughout the country. But I want to also make sure that you leave with an open mind. We're very much scratching the surface on ideas, what we can put together. You know, we'd work very closely with Ian's group, with my group, and yourselves based on views and access, and you know what would make sense from a risk return type payoff. So. Again, this is just a very, very small subset on some more common stuff that we've recently done. So the first example, it's a Canadian bank's principal protected note. So the way that it works is that we link it, let's say, to the TSX Banks Index. If the Banks Index goes up over time, on a price return basis, you get 1-to-1 on the upside. If the Banks Index goes down, we give you your money back. Right, so the way to look at this and to compare it is not necessarily, against directly investing in equities, because it's not. This is a better comparison as a yield kicker in your bond portfolio, because that's what you're buying is a piece of bond. So the idea would be, all right, over the longer term, over 6 years, and by the way, too, it was mentioned earlier that our PPNs are typically 7 years. That's not the case at all. It's basically whatever term that, the municipality or the client would require. So typically, from it to make sense from a pricing standpoint, we do these anywhere from 2 years up to, some of them can be done for 15 years. Right? So in this circumstance, again, if the bank's index goes up, you make 1-to-1 on the upside. If it goes down, we give you your money back. The question is, over a 6-year period, do we think the bank's index is going to do better than 2% per annum, or whatever you can invest in traditional fixed income? Right? The opportunity cost is your 2% per annum. However, looking backwards, I'm actually much more of a forward-looking person, mind you, but if you look at it backwards, if you have to start somewhere, this note would have paid approximately 90% on average over, a 6-year period. Right, or compound rate of 11.28. And the way that we established that is we looked at when the Canadian Banks Index started, which was, I think, in the late 70s off the top of my head. It's in the fine print somewhere there. And we back-tested it, looking at every single day what would have happened over a 6-year time horizon. And the average return you would have earned is 11.28. And the years that it would be down, which is a rounding error, I think, at the bottom, meaning how often over 6 years is the Canadian Banks Index down? It's 0.3, I think, that's what it says. So we would return your money. In other words, 99.7% of the time in this specific product over the last 40 years, you would have made a positive return. And on average, it would have been 90%. Okay? Now, the other thing too is sometimes it's not great to set on an investment and not see any type of cash flow return over, the stipulated period. Right? Some investors want to see that type, at least some, coupon or, interest payment where there's actually something tangible that hits the account every year. Well, no problem. We can put something together like that too. That would be at the cost of what the participation rate would be on the equity component. But in this example here, we can guarantee you 1% per annum, let's say, in guaranteed coupons, and we'll give you half the upside of the TSX Banks Index. So you can see from at least a minimal 1% guarantee, we can only give you about half the upside. Right? And that's basically because from a funding perspective, if we're working with a bond, that's what happens. Treasury gives us the 2% rate, let's say for 5 years, and we construct this trade based on that. If we have to pay out half of it, in guaranteed coupons, then that has to come from somewhere. We only have half the amount to go out and invest in the stock market or whatever we want to, link it to. Something else that was brought up earlier today as well, and again, I'm not trying to compare versus one funds, but from a dividend perspective, you do actually get compensation one way or another in the structure. Meaning, I think in the past there's been this idea that the banks keep dividends, we own the shares, and something along those lines. It's far, far, far from the truth. The bank isn't out there as a casino taking bets like that, at least not in Canada. We make money in 2 fashions. Number one, you give us a deposit. You're giving us, just like in a high interest savings account, or you buy a 5-year GIC, you're giving us a deposit, and our treasury can go lend that out to another counterparty. right? The other area is there's an option market, an option markup on the equity component, which is typically around 1 to 1.5% total over 5 years, which has no bearing, zero effect to your payout at maturity. You give us $100 up front, you get paid based on the rules of the trade on your original $100. It's not 100 minus your fees, because there are no fees technically in the structure as well. So from a dividend perspective, going back as well, the way you get compensated is if the stocks have a higher dividend amount, it's cheaper to put the equity component together in this trade. So if we find stocks with 4, 5, 6% dividends on them, and you're comfortable looking at that, instead of paying you 1 to 1, let's say on the previous example on the upside, maybe we can pay you 2 to 1 on the upside. So in other words, if the market goes up 10% over 5 years, we pay you 20. And if the market goes down, we give you your money back. Guaranteed, rules-based, no ifs, ands, or buts around it. In fact, Ian and I structured that for another one of his clients 3 months ago. Right, so there is, what I'm trying to highlight is there are ways, there is a mechanism in place where, yes, you don't see that dividend payment, but that actually gets translated into a better looking or higher participation type product. Okay, and then another example as well, this is something we recently executed too, from a municipality standpoint, from an equity investment, a lot of the times, you can invest in Canadian equities. I'm not sure if you can actually invest directly with one funds through US, et cetera. But we can create products, again, that are guaranteed by the bank. It's a deposit note that gives you access to international markets in a currency hedged fashion. Right, so in this example here, Eurostoxx 50, it's, made up of the 50, or roughly the 50 biggest companies in the Eurozone. And we would pay 90% of the upside over 6 years. So if it goes up 10%, we'll pay you a 9% coupon, in other words. And if the market goes lower, you get your money back. Now, a key to this as well is that you have zero interest rate risk when it comes to euro. Eurostoxx 50 is domiciled in euros. The currency fluctuations as a Canadian investor could have a massive, massive swing, positive or negative, on what your returns would be after the term. But in this case here, we can nullify or mitigate all of it. Right, so this gives you another diversifying tool in bond format that allows you to invest in international markets with zero currency risk attached to it. Right, obviously we can do the same thing with the American market, other stuff around the world. We just have to kind of check with our trading desk on what's hedgeable and what's not. But, in terms of getting crafty and coming up with ideas, there's, again, so many different ways we can mix and match this type of thing. Mr. Mayor, how am I doing on time?
Well, in one more minute, I was going to tell you have 3. So
Okay,
I'm going
great.
to tell you now you have 4.
I got 4. All right, perfect. So in this case here, this is just another example of just a general principal protected note. We link it to a whole bunch of Canadian stocks, most of all you'd probably be familiar with. These ones are higher paying dividend stocks typically than the Canadian banks, although I know there are some Canadian banks in there. And in this example, we pay you 1.3% of the upside and give you your money back at maturity if it's lower. Right, so again, because the dividend yields are higher on these stocks in general, we can pay you a higher participation rate. Okay, just for the sake of time, I'm going to skip this example. This is more of a fixed rate alternative from a bond perspective. There's just a few different moving parts to it, but I'm happy to answer questions on it, via email later. This is a good 5-year alternative deposit note where basically we can pay you the growth of a dividend in bond format. We give you a starting coupon, and if a certain share raises their dividend, which let's say in the example TD Bank has historically done every single year by minus, I guess, sometimes during the recession, there was kind of a brief period where they didn't. But in general, over 10 years, TD's hiked their dividend by 10% per annum. If they continue to do that, your coupon would grow at 10% per annum. Right? So there's an inherent guarantee, hopefully, that TD keeps hiking. It doesn't have to be TD. We can look at anything. I did one of these on Enbridge because they publicly come out and stated that they're going to grow their dividend by 8 to 10% for the next 3 years. Just a different way to look at senior deposit notes. Instead of just your fixed rate 2% GIC, we can kind of get creative with something like this where the odds of growing your coupon and getting a higher yield while still protected are in your favor, at least from a historical standpoint. Okay, and this here, so this is just an example of something we actually have in the market now too, but or it's a little bit better. But So an auto-callable principal protected note, we sell billions of these auto-callable notes in an at-risk format through either institutional managers. A lot of it's actually done through high net worth and through the brokerages. And the way that this product works is that, in this case, we're referencing 5 or 4 different stocks. They're having to be beat up right now. Did you have a question, sir?
Wait till you're finished.
Sorry. And the way that this works, again, your capital is 100% guaranteed. We're waiting for any year that those stocks are merely flat or positive. The second that they're flat or positive, we're going to give you your money back and give you a 4% coupon per annum. So in year 1, if they're flat or higher, we give you your money back and pay you a 4% real dollar coupon. If not all is lost. It goes to year 2. Nothing happens in year 1. We don't pay you a coupon. In year 2, if they're flat or higher from the start, we give you 8. If not, it goes to year 3, we give you 12, et cetera, and it keeps growing to, in this case, 20% or 4% per annum. If at maturity it's never been positive, we've been in a bear market for that period, you get your money back.
About half a minute, Barry, please.
Perfect. Oop. So there's a few different examples like that. We also have just a few other non-traditional deposit notes. These are yield-based solutions. We're talking about higher rates. This is one that we utilize quite often. It's actually a hybrid solution that gives you a minimum coupon if rates are low and pays you a higher coupon if rates go higher. And then another one as well is a callable note that the longer you're in the trade, the higher the coupon you receive.
Okay, Barry, I'm going to stop you there, and I know there will be some questions. So thank you very much. Questions
you.
from, I'll start with Councillor Brunton, and then I'll go to Councillor Oliver.
Thank you. Thank you, Mayor Luke. You really think Enbridge will boost their dividend? You got a lot of debt, eh?
I hope so.
Yeah. Anyways, a couple of questions. And Ian, you're familiar. We have that PPN with the Conservation Authority. It hasn't fared well.
Right.
And I guess the question I have is, the way I understand it, and I know you gave the banks as an example, it's probably one of the best ones you could probably invest in, but my question is very simple, and I didn't ask this a few months back when we talked, but you have a PPN with, or a portfolio, say, of 10 stocks in there, and I apologize because I didn't know what PPN was back then, but I educated myself, and I said, I thought you bought those stocks, but you told me you don't buy them. Okay, my question is, if you don't buy, say, 10 stocks in that portfolio, what do you do with the money?
I can answer that.
So I'm going to give you an example. We give you $70 million. Wouldn't buy one maybe, but we'd maybe buy a couple of portfolios. What do you do with that money?
Right, so in a PPN, again, it's a bond, it's a variable rate bond.
Right.
Treasury takes it from us,
Yeah.
and they would go loan it. So
At a higher rate.
in other words, it could go to somebody's mortgage, or it could go out to a corporate client that's looking to borrow money from us. I'm not exactly sure how Treasury would chop the pie, but that's let's say 90% of it, or what the zero coupon bond is worth. The other 10%, or whatever the discounted value is, our trading desk goes out and hedges the product through the options market.
So, and that would be at a fixed income, would it not? That whatever you put it into a mortgage or whatever?
Well, so correct. So if the zero coupon bond, whatever the current deposit note rate is today, let's say your GIC rate's 2.5% for 5 years. Okay. So Treasury gives us 2.5% for 5 years as well, except for paying out 2.5 every year. We basically have it as a zero. So it compounds lower to, let's say, $87. So instead of paying out the investor or, the deposit holder 2.5% per annum, we pay them based on whatever the other set of rules are, right? So we work with the lower, we give Treasury the discounted value, and then our trading desk has the other $13 to hedge the payoff or the rules around, how the note would earn money.
Okay. So it isn't all invested then?
Correct.
Okay, I got it. Thank you.
Thank you, Councillor Oliver.
Thank you, Mr. Mayor. I think I've already sort of forgotten the technicalities of where my question was going to go, but the one that you mentioned just at the end, Barry, I think the suggested product where if it was flat or positive, there was going to be a 4%
Correct.
payment, and in other words, if it was flat or negative, there's no payment. Is that, just explain that a little bit further. Yeah, that's the one.
Sure. So the way this product works, let's pretend there's not 5 stocks. Let's just pretend there's an index, and the index value is 1,000. A year from now, if the index value is 1,000 or higher, we give you your money back, your $100 deposit, and we pay you a 4% coupon. If the index is below 1,000, meaning we're in some form of a bear market, nothing happens. It goes to year 2, at which point the same decisions run. Are we at 1,000 or higher? If the answer is yes, now we pay you an 8% coupon. If the answer is no, it goes to year 3, at which point the same decisions run. If it's flat or higher, we'll pay you a 12% coupon. If not, it goes to year 4 and year 5, etc. And if over 5 years on those dates we're still in a bad market, your money gets returned to you. The 100, unless CIBC goes bankrupt, which then that would be a different environment for sure.
So if you look at the back testing on those 2 notes, the one note would have paid out 100% of the time, and the other note would have paid out 93% of the time, was it, Barry? So very high probability.
We just don't know when that would be, right? It could be in year 1 to year 2. Like, you know, timing is kind of important. Over the longer term, it's probably not as important unless you're investing in some one-off kind of crazy type market. So this is just a way of, you know, looking at it and again comparing it to fixed income, where you can go and get, let's say, 2% or 2.5% or whatever the number is on the same level of guarantee for 5 years. Now, I can't guarantee you we're going to pay you 4% per annum, but hopefully the odds are stacked in your favor that at some point over 5 years you get 4%. If there's no other upside to the trade, there's no other downside, it's just 4% per annum or nothing effectively.
Thank you very much. That does explain it. And then 2 related questions. Would that kind of an investment allow for any sort of annual payment that you've heard we've talked about? And one of the things we want out of this next round of investing of the legacy fund is that we would see some, as our previous speakers talked about, some real cash coming to the county each year to do with what we please, i.e. put into our reserves for roads, et cetera. So could we have something like this and achieve that? We really couldn't, could we? We'd have to be prepared to wait up to that 5 years, and then we would get it all, quote, retroactively back, assuming it was 0 or positive.
Correct. I mean, you could be waiting as long as 5 years.
Correct.
And the worst case scenario would be you get your money back.
Okay.
With no payment.
All right.
And now, typically when we're structuring these portfolios, though, we're using a combination of fixed income notes that we'll pay on a regular basis, and some growth notes. And on top of that, for all the municipalities and counties that I deal with, we have a bond component where we manage a portfolio of individual bonds. We like to buy the individual bonds because we're concerned about owning a bond pool or a bond mutual fund in a rising rate environment. We feel if you own the individual bonds, worst case, you've bought a 4-year province of BC at 220, and rates go up, you hold it, you get your 220. So we prefer to see those individual bonds as opposed, so we always have that component. But then we also have PPN notes, like I said, that are fixed income ones that will pay annually. Some of them pay quarterly. And then on top of that, we'll mix in some growth notes. The growth notes, again, there's a daily valuation on those, and there's been times where we've owned notes that have done so well in the early stages that we've taken some profit and basically, reset the floor, reset the guarantee. So again, that's another form of income that can be realized as those notes go up in value as well.
So, and my final question on that one, and perhaps back to you again, Barry, is would that 4% presumably at some point over the 5-year term, is that net of fees, net of any fees of the bank?
Right, so there's no fee attached to this
There's no
product.
fee. You're just going to use our money
Correct.
in the intervening time, and that's where you will get your
Correct.
fee out of it.
Correct. So,
Okay.
so you give us $100. At maturity, the worst you get back is $100. It's not 100 minus any type of, drip or fee, etc.
We do that flat or up, we're going to get, let's say it doesn't happen to year 4, we're going to get 4% per year for each of those 4 years. And that too is net of any fee of yours, correct?
Correct. Again, there's no fee or anything like that.
Understood.
When we build these for institutions. And sorry, just if I could quickly, just you were asking too about building guarantees into these products, and the answer is yes. The one issue though is, we often get asked the question, what's the maximum amount you can guarantee in terms of coupon payments when it comes to something like this? And the answer is whatever our funding rate is. So if Treasury says we'll give you 2.5% per annum, the most I can pay you is 2.5% per annum. But the problem with that is then I have zero room left to actually go out and build the equity component to it.
Further questions? Mr. Brunton?
Just, I forgot, you have as low as 1 year right up to, did I hear that?
I mean, we can price stuff at 1 year. It may not make sense from a
Right.
pricing standpoint at the moment, but we can do stuff. I'd say 2 years is probably the starting.
Up to,
Well, it depends upon the structure. For most of our equity-linked stuff, it's 7 or 8 years, depending upon how liquid the underlying is for us to hedge it. For a lot of the interest-based notes, we can do 15 years on them as well.
okay, thank you.
Further questions? Just one question for me. I want to talk about the term. Some of these programs, the PPN programs, I noticed were 6 years. Some were 5. This one's 5. So,
Hopefully that one's 1 year.
okay. My questions, I have two, and one is, if you were to take the money and put it into one of these 5 or 6 year PPN programs, I'll call it that, I don't know all the jargon, our money would be tied up in its entirety for that length of period, correct?
No, that's not correct.
Okay, well,
So if we structure this as a market-linked GIC, then there would not be any liquidity, just like a typical traditional fixed-rate GIC. Now, if we did that, that stays on your statement at $100, which probably makes accounting a little bit easier, and then you got to pay off at maturity. If we structure it through a regular deposit note that doesn't have a GIC wrapper to it, we can give you a daily mark-to-market. You can call Ian at 10 o'clock in the morning. Ian calls me at 10:01, and I have a price for you for $5,000 or $5 million at the same price, because it's just whatever the net asset value of the components are worth within, call it 5 minutes.
so this, one of these programs, if not all of them, could be set up that we would get an annual payout should we choose to say, I'm just throwing, I'm not, that's the treasurer over there.
Right.
For say, $2 million a year, we could set that up so that could be paid to the county out of the principal, correct?
Correct. Well, the other way that we could look at doing that as well is having a ladder, somewhat similar to a bond ladder.
Yes.
Where you have stipulated guaranteed payouts.
Okay.
Every year, so you wouldn't necessarily have to liquidate or sell back in a secondary.
I'm somewhat familiar with that. What's your reporting period on investment income or interest? Is it every 6 months, quarterly, 1 year?
We typically do monthly reporting. Some find that a little daunting and they ask us to switch to quarterly, but we offer monthly reporting. So there's both, email, paper, however people like to see it.
Yeah.
And, the comment, just to add on to Barry's very quickly, with a portfolio of this size, obviously that would be, a portfolio of PPNs. This wouldn't be a situation where you'd pick 2 or 3 PPNs and put $70 million in them. We would build, a portfolio of PPNs for sure.
Thank you. Got it. Thank you. Any other questions for these gentlemen? Thank you very much.
Thank you very much for your time.
Ian and Barry, thank you very much for being here. Anything further from council? Why don't we go to page 7 of our agenda, and we'll turn this over to Mr. Johnson to give us, his report, FS 18-06. Thank you, Councilor Wright. Mr. Johnson?
Certainly the floor is Mr. Johnson's, but I should take the opportunity to offer an apology to any member of the now former Financial Advisory Committee on page 2, page 8 of our agenda, page 204 of the report. I think I made a really poor choice of words indicating council's dissatisfaction with the advisory committee in that report. Nothing was meant by that, and I note that my own job position and Mr. Johnson's were part of that committee. That being said, that's really not what we meant to say. It was disbanded so that the reports could come straight to council, because all council members understand the importance of, how we run our $69 million nest egg and what it is we're going to do with it and how we go forward as a community. And that's really what should have been said. So the choice of words was my own. I own that, and I do want to apologize in the event I caused some offense. And with that being said, I'd like to turn over to Mr. Johnson to get back to substance. Thank you.
And Mr. Cribbs, I want to thank you very much for that explanation. It's very much appreciated. Mr. Johnson, let's get on to the report.
Thank you, Mr. Mayor. Through the mayor to members of council. The report before you, I don't know if you noticed the title, it says biannual report. We plan on bringing a report to council twice a year with the performance of the legacy fund. And I also want to bring to council's attention that this report before you deals with our long-term investments. The legacy fund is a unique opportunity to Norfolk County where we can take that $68 to $70 million and invest it in the long term to have the best kind of return that we can get. The other investment instruments that Norfolk uses on the short term, we have a very good short-term program where we invest in GICs and other instruments over 30, 60, and 90-day rotations in order to take advantage of rates above and beyond our regular bank rate, and also look after the liquidity that we need in order to run our business. What we are missing is our medium-term investments. We do short-term very well, and we would like to do very well with the legacy fund. However, with the reserve situation that we have now with those balances, we don't have the opportunity to go into more medium-term investment strategies. So that's part of the reason why CIBC was invited here today, to get an education on the PPNs, and also perhaps we can take advantage of what they offer once our reserve situation is in a healthier state, where we can use more of a medium-term investment strategy along with our short-term and our long-term. Council can recall at the November budget overview and economic outlook meeting, One Fund Investments presented the results of the legacy fund portfolio, and as you can see in the report, the last fiscal year they were not well received. The results, as well as details of where the earnings were and where the interest earnings have been used in the past, you can see in attachment 1 and 2 of the report. There was good discussion at the November meeting on investment instruments used, and also the endowment model was introduced, and that is part of the reason why we're here today, is to have more of a discussion on the endowment model. Staff is recommending that the One Fund endowment model be used to ensure a sustainable payment for the committed funds towards the Norfolk General Hospital as well as the Roads Reserve. This is a relatively recent product from One Fund. Several municipalities, including the City of Stratford, are working with One Fund to tailor this new model to municipal needs. Staff would also endorse investigating other instruments, as mentioned, such as the PPNs, once the reserve balances get to a point of longer-term investments. There have been recent regulations released related to investments for municipalities, as mentioned in the presentations. These new investment options take place, as mentioned, January 1st, 2019. Staff recommend to stay the course for now until the regulations do come out, and then we can further investigate what kind of options we have at that time. Staff will commit to continually communicate the changes in policy, asset mixes, and new legislations, either through biannual reports, information memos, and also the budget overview and economic updates that we were doing on an annual basis. And with that, I would be happy to answer any questions that Councillor
Thank you very much, Mr. Johnson. Questions for Mr. Johnson? Councillor Height, please.
Thank you, Mayor Luke. Through you to the Treasurer. Seeing as how we're short $500,000 now for the hospital funding, where do we get that money from?
Through you, Mr. Mayor, the recommendation in the report is to, for this year, not contribute to the hospital or the roads reserve. However, that would be the priority once we get enough earnings past the $2.5 million a year, and then that would be the first thing we would do any extra funds committed to.
And that's assuming we make more money than what we made right now, correct?
through you, Mr. Mayor, through the presentation that we had with the one fund, correct.
Okay, so my next question would be, I was under the impression that the hospital funding was a special levy charge, and it appeared that way. How did it end up in the investment side of things? Did I miss something there?
Through you, Mr. Mayor, no, you didn't miss something. I believe it was the 2016 budget presentation where there was a levy of $500,000 in that budget presentation. However, since then, the decision was made to use the legacy fund for those contributions to the Norfolk General Hospital.
So that decision, was that done at council?
I believe that decision was done through the advisory committee, and that was brought to council after the advisory committee.
Okay, that makes sense now. Are we able to hold our own bonds?
Through you, Mr. Mayor, we can trade bonds through a broker, and I've done that at previous municipalities, and that is a possibility, yes.
Okay, and my last question, I guess, I looked at the bond market today and I saw what Norfolk were paying out 2.6 something % interest. Is that how that works? And how do we actually make the payment side of things? Is it a 5-year term and we pay at the end of 5 years, or how does that actually work?
Sorry, through you, Mr. Mayor, this needs clarification. Are you talking about issuing bonds ourselves as a debt issue?
Right.
My understanding on that, through you, Mr. Mayor, is that we would issue, we could issue a 5-year, 10-year type of bond, and yes, we would do payments either on a semi-annual basis or on an annual basis. There's different methodologies that we could use.
Okay, thank you.
Thank you. Mr. Johnson, my one question is, I am not convinced the place to put the $275,000 interest from last year is in the retention reserve as opposed to the hospital commitment. I'm going to ask you to comment on that further in the context that we have, since the inception of this investment, put money in our retention reserve each year. We've been able to do that so that when we get a lean year, such as we had last year on the $2 million to put into reserves. So I'm thinking either way, we don't have enough money to fulfill what we've been doing. Would it not make more sense, rather than to fall behind $1 million in our 10-year commitment to the hospital, to get that 2017 commitment of $500,000, get it somehow in there, and but I always figure it's better to look after your commitments to others than it is to your own commitment. Am I out of line with that? I know we differ on that. I respect your opinion. What is your big concern in missing the retention reserve for 1 year of a couple $100,000?
Through you, Mr. Mayor, we have, I'm not sure where you got the $1 million from. If we miss this year, it would be a $500,000 missed payment.
Well, I'm sorry, I was under the assumption that 2017, we did not in 2017 make the 500,000. We made 500 in 2015, another 5, it's in here, in 16, but we didn't make any last year because we took 500,000 last year budget time out of the 2016, the 2.9 million. But we didn't take anything out of the 275 for 2017. Have I got my dates wrong? Correct me if I do.
Mr. Mayor, it could be because we have the fiscal year from August to September. Yes. And so from 16 to 17, where we had the poor return, that's the year that we would not be contribute to the Norfolk General Hospital. However, the 2 fiscal years prior to that, we did. So from September 2017 to August 2018, if we go through with the endowment model, then we would be able to commit that 500,000 for that year.
I guess because we took it out of last year's 2.9, for some reason I'm thinking we're not taking any out this year, so we're going to miss a year. I got it. My last comment is, Councillor Height, your question was excellent. It was the advisory committee that recommended to council, because we had a 2.9 In 2016, we put 2 million, we recommended to council 2 million in reserves, another 250,000 roughly in the retention reserve, and we still had $750,000 left over. So we said, what are we going to do with it? Well, we had a number of options, but we recommended to council that the 500,000 be put on the hospital, NGH's commitment, and 250 kept for some roads and perhaps recreation consultant, whatever. So that's what council decided on the recommendation advisory. Thank you, Mr. Johnson. Other questions? Councillor Brunton, then Columbus and Oliver.
Thank you, Mayor Luke. My question to James is, what's somewhat disappointing to me, and is we knew on September of 2017 that things weren't good. I don't know if, I think I asked the question in open council, how things looked, and I can't remember, James, if you gave me the scoop back then on open council, but here it is 7 months later, 7 months since we've realized that we've had a problem. And I guess I would hope, and I know it says in your report, you're supposed to report twice a year, but I would hope that we would have made this kind of presentation and decision September 2nd, I guess, if I could use that word. I mean, that's maybe too short a notice, but to sit and wait almost 7 months now to come up with some idea, to me just isn't right for the taxpayer, I don't think. But I guess my question is, can you tell me how we've done since September 1st? How's things look? I assume our money is floating around someplace out there and some investment. Like, how's it? The market certainly took a dive in the last couple of months, so I assume it's not good?
Through you, Mr. Mayor, to Councillor Brunton, in the attachment 2, I believe, of the report, or sorry, attachment 1, I do have a monthly breakdown of how our portfolio as a whole has done, and you can see after August of 2017, there was a few really, really good months, and then there was some bad months after that, probably when the market took a turn, like what you just said.
So that's on that page 11 you're referring to, I believe. I guess while we're on that page, if I may, the fees they indicated were taken out quarterly.
Through you, Mr. Mayor, yes, that's what was said.
So it doesn't show on here where they were removed. I assume it's in the balance, but it's not. It doesn't show the actual fee taken out, does it?
This appendix for this report doesn't have the fees netted out. However, that is something I can definitely do going forward when we do have the next biannual report.
Okay, and you said in your report, and I think it says on page 8, right at the bottom, it says manager's fees will be outlined during the presentation of the one fund. So am I assuming that's what they said, 313,000? But that was an average, I thought they said, for the overall since inception. Am I right on that?
Through you, Mr. Mayor, I believe they calculated based on average balances, if I'm getting a nod from Donna. Or Donna, maybe you can answer that question.
Yep.
Thank you, sorry. All the returns that you're looking at are net of fees.
Sorry to interrupt. I do not, Donna, my apologies, I don't want to start bringing back our presentations. I think we bring one, we bring the other and all. So again, the question is fair, but I'm not going to allow to start bringing back. If there was just one, that would be different. But I think that we'll just leave it at that. Sorry, Councillor Brunton, but I think we want to try to be as fair as we can here. My apologies, Donna, for jumping on you.
Okay, well, I guess this I believe it was 313,000 is the average fee per annum, correct? Is that what I?
Through you, Mr. Mayor, those fees are calculated based on the 12 months, the average balances of the 12 months in 2017.
Okay, well, you said you're going to show that going forward. Thank you.
Columbus, please, then Councillor Oliver.
Thank you, Mr. Mayor. To James, with respect to the prudent person that we're hearing more and more about that can come into effect in January 2019, Do you know if there's other municipalities would have an appetite to move that way? Have you talked to any of them?
That's a good question through you, Mr. Mayor, to Councillor Columbus. This is very early. These are in the early stages of that new legislation, and through some area treasurers meetings that I will be going to, there is discussion. Actually, I'm going to one next Friday, and it is on the agenda. So I imagine there will be discussion on municipalities, quote unquote, pooling their resources in order to take advantage of the new legislation. However, I also understand that the One Fund will be also trying to come up with avenues to take advantage of the new legislation through their portfolios as well.
And what would the minimum limit of dollars have to be? We've got, say, 70 million, but what's the minimum in order to go to the prudent person route?
The minimum through the legislation to use the prudent investor regulation is $100 million in the portfolio. Once we're pooled, if we go the pooled route with other municipalities, it just all depends on the share that we put in order to meet that minimum.
Thank you.
Thank you. Councillor Oliver.
Mr. Mayor, I think my question has been answered, and it was relating to Councillor Brunton's about what our earnings are so far in the subsequent year. And I remember when our One Investment Fund folks were here back in November, they indicated, and I can see from page 11 of our agenda, things were looking up. But now that we're 6 months into the latest fiscal year, our earnings are only sitting at 313,000 roughly. If I'm reading that correct on attachment 1, James? Our earnings to date net are 317,000.
Through you, Mr. Mayor, Councillor Oliver, you are correct.
After 6 months. Okay, thank you.
Councillor Height, please. Thank you.
Mayor Luke, through you to our treasurer. How often do you meet with the team from the One?
Through you, Mr. Mayor, I believe through our legacy fund policy, we're supposed to meet on a quarterly basis. However, we have been meeting more often recently because of since the November meeting, and we've been talking, I believe, every other week to come up with the plan that we have before you today.
So my question to you, like during the meeting, they mentioned in the portfolio that's before us today, they're looking really to get a higher maximum for equities. So, but it's already sitting at 30% and they're only 19% in. Staff wasn't holding them back from making those moves. Is that not correct?
Staff have exercised no control whatsoever, had no input on the investment decisions.
Okay, because even like our minimums, like the bonds and the corporate bonds, which they look like pretty weak investments according to this, they're heavily weighted again. They could have been moved around, at the advisor's call, I'm assuming, and maybe brought us in a better return. I'm disappointed. We made $275,000 and the fees were $313,000. It's a pretty tough sell right here. So I don't know, Mr. Treasurer, how competent are you at handling the bond side of things? I don't mean corporate bonds, I mean bonds. It's weighted in here, $30 million. There was $120,000 in fees. Bonds are pretty straightforward. There isn't a lot of management, and certainly not $120,000 that I feel is worth being managed, especially with these returns.
Through you, Mr. Mayor, the Finance Department can definitely handle issuing bonds ourselves through a brokerage firm. I'm not sure the logistics of that because we don't have anybody on file right now. I do know that to do that course of action requires a significant more staff time in order to administer it. One of the great things about having One Fund or other instruments is they do a lot of administration on behalf of Norfolk County. So if we were to go a route where we wanted to handle our investments more directly, there would be a resource issue.
Well, $120,000 would fix that resource issue, wouldn't it? Thank you.
Further questions? My last question, Mr. Johnson, is about the whole timing, whichever way we go. Rules will be changing in 2019. We currently go from a September 1st to August 31st timeframe, so we certainly are well into the second term. We're actually 7 months into it. So I'm not sure what your thoughts are, whether we go with a change from our current program at this time, or we should ride out till the end of August. Do we want to get in a January, December? We know that we'll have a new council coming in very, very shortly, 1st of December. You know, I always like making decisions, and I'm not sure that this report has convinced me which way to go, to be blunt. Do you have any thoughts of what you see unfolding here for the best course to take?
Thank you, Mr. Mayor. I do. First of all, one of the things I'd like to do is to change the fiscal year from August to September to the calendar year. The reason why it was set up like that originally is because we would find out what the investment earnings are, and then we could use them for the budget time period. If we go with the endowment model, we would have a sustainable payment. We would know what that payment is, so we can keep the calendar year as the reporting period rather than in the middle. As far as when to transition from our current model to the endowment model, we would have to be careful with that because we wouldn't want to make any changes from bond to equity and have a realized loss. So I would work very closely with Kelly and Donna from the One Fund to make sure that we're doing it in a timely but also an efficient manner.
Thank you. Anything further for our treasurer? Thank you very much, Mr. Johnson. Well, I turn it over to council. I know there's a staff recommendation on the treasurer's report. Do you want to look at that recommendation? You have an alternate recommendation. The chair is open for direction. Councillor Brunton, please.
Your Worship, I'll say this, I've been quite disappointed, and you know, we seem to have people come in and we listen to these two groups, and I have no personal disappointment with these groups, but we owe it to the taxpayer to get the best return we can on almost $70 million, and we certainly haven't done that in the last year. Sorry, 19 months almost. I would like to see us go to the open market with this amount of money and try and get an RFP to come back with a with guarantee on the principal and a guarantee on the say a maximum return. Anything above that, I guess, would be a bonus. An RFP in that nature. I called today just to give you an idea. You can get an 18-month investment on $100,000, guaranteed 2%. I don't know. I didn't like all the jargon that was presented to us, you know, guarantee this, guarantee that. I think we owe it to get the best we can, and there are other banks out there that might be able to provide that. So I would like to see that. I'd like to see an RFP where we can bring in all the investment firms, banks. I don't want to go to all these, and I'll use the word Mickey Mouse investors that are out there. There's all kinds of them, and I like to stick with the banks, and I would support the One Fund, the banks or their investment firms. Let the One Fund have a shot at it too, but I think we may be in for surprise with some of the guarantees they might put forward to us. So that's where I like to see it. Thank you.
Well, before we get into discussion, we'll need a motion. And I am fully aware that in 6 minutes, and we haven't had our break, we need to start a public meeting. I think this is a very important report and issue, so I leave that to you.